Hi everyone, it's Angus here from the Macro Shop, recording this late afternoon of Tuesday, July the 7th, 2026. What I want to do now, guys, in a very short video is just showing you a trade I did this morning, selling a put spread on the ES futures. I just want to take you through the mechanics of the trade, the execution, and a little bit of the reasoning. Just do a short video here, 5 or 6 minutes. Okay, so first of all, always you need to know the context. So what we have here is the ES S&P futures. This is a 3-minute chart. So you can see here the opening range was a little bit from 9:30 here. You see the opening range was a little bit sort of on the heavy side. Now, that's to be expected because we know that overnight, what's the context? The context is that Samsung over in South Korea had stellar earnings, had a really, really powerful earnings, but it disappointed the market a little bit because the market maybe was doing some profit taking, maybe was, just a slightly disappointed, or the earnings were baked in. But the point is that even despite their incredible earnings, what we saw is that East Asian tech stocks and specifically chip makers and memory makers like SK Hynix and Micron and Samsung itself sold off a little bit. Therefore, this morning, could we expect a little bit of a shakeout, a little bit of a sell-off in the Nasdaq and maybe by its cousin, the ES? Absolutely. So what I wanted to do was to sell some put spreads to get some income and also to express a bit of a bullish sort of sentiment. So basically what I first of all did, I waited until we had the sell-off. Okay, you've got to wait for the sell-off because if you're selling put spreads, obviously what you don't want is to be sort of selling at the top and then the market comes down and of course your premium explodes and you have a problem. You have a big problem here. So, okay, so we waited for this to come down, and generally what I like to do, I like to see a 15, 20, 25 point sell-off at a minimum, just get a better entry price. And you can see here that we had about a 40-point sort of sell-off, and I thought that's looking interesting. Now, what I noticed here is that you see that we're starting to hit sort of key levels around about 75.40, around about 10.30 here or so. And also that coincided, you see on the RSI down here, started to be a little bit sort of oversold in the very short term. So I thought this is not a bad place to enter. And you can see here that I actually entered the trade here at just about 10.20. You see just right about here. And I thought that was a pretty good sort of entry point. Now, in terms of the mechanics here, let's just see what I actually did. So what I did, I always, as I enter trades, always do a screenshot. So this is from my Interactive Brokers. And you can see here the option chain for the ES futures. So, of course, this is priced not in dollars and cents, but in points. Each point, of course, is $50. And what we can see here is that I decided that for the short leg, so the short put here had a delta of about 21.6, and then with a 15 point, so 60 ticks, but let's say 15-point spread, and the long put here had a delta of 13.6. So what we can see down here is that the overall delta of the spread, so that's basically the short put had 21.6, the long put had 13.6 delta. So out of the money, but not obscenely deep out of the money, enough to pay me a nice premium, but also close enough with the 15-point spread that if the market were to go down in an aggressive way, the long put, the gamma would kick in and that delta would kick in pretty aggressively as well. So that's why there's no point having a super wide spread, because your long put at that point essentially is going to leave you naked. So I personally on this one decided to go with a 15-point spread. So the first strike 75.10 and the lower long put at 74.95. Now you see what was that paying me? It was 520 and 310 approximately. So you can see here that I received as the premium on the short, I think 5.2 points, and then I had to pay out on the long put for protection 3.1 points. And remember, a point is $50, so you can do the maths. Now that left me with a spread delta of 0.8, so fairly out of the money, pretty conservative, quite far away. But again, the long put is giving you quite good protection because it's relatively close, only 15 points to your short put. Now, what was that costing me? The premium which I received was two points, which of course 1 point is $50, so that's per contract, doing multiple contracts. But in this case, let's say one contract is $100 premium. So that's the thing. I entered with a premium of 2 points with an overall spread delta of 0.8. Okay, you can see here I entered at 10.25 in 7 seconds, and there's my bull put spread. Okay, so what do I want to happen now? Obviously, what I want to happen is for the market to go up. So let's just go back. Actually, that's a screenshot. Let's go back to the live chart. So obviously, what I want to happen to profit from that, because it's a short put, I want the market to go up. And now I've waited for a nice little sell-off, and I want the market to go up. Now, at this point, I'm starting to sweat a little bit, not too much. Remember, 3-minute candles. So after 10 or 15 minutes, I get in, I see a nice little green candle. I'm like, this is great. Life's good. And immediately my premium reduced to about 1.5 points. So I'm already on side by about 0.5 points, which is nice. But then, of course, unfortunately, it continued to sort of sell off a little bit. And at this point, the premium then expanded a little bit to about 2.5. So down here, I was starting to sort of scratch my, not that I have a beard, but sort of stroke my chin and say, do I stay in this? Now, normally what I like to do, I have a stop loss normally at about 2.5, 2.6, 2.7, 3 times the premium. I'm not going to let this thing bleed all the way down, because that would give me a maximum loss of 15 points on the spread, which equates to about $750 per contract, which I personally don't want to do. So my personal way of trading these short put spreads is to have the stop loss set at about 3 times the premium received. So in this case, the premium received, you remember, was 2 points or $100 per contract. I put the stop loss at about a 2.5 to 3 times that. So that works out at about 550 points to 6 points, something like that. And that means if it sells off aggressively, it needs to be pretty aggressive to sell off. I'll take a loss, once you subtract the premium received, or let's say 3 points, and you go, okay, live to live another day. Now, what we can see here is that I'm constantly looking to see, so you can see it was still oversold, but less and less so. And so also on the MACD, I'm thinking that this might bounce soon. So I was under a little bit of pressure here, not much, just down 0.5 point on the premium, had a nice bounce. Then, of course, it started to come down a little bit. Now, of course, I'm watching it. I'm watching other markets at this point. I'm keeping my eye on the SMH, the semiconductors, on NVIDIA, on Micron, on the Korean ETF, South Korean ETF, EWY. So it's very important to be looking at all of the correlated markets. And it seemed to me that, yes, the tech stocks were heavy, but, a lot of the selling was starting to stabilize. You can see here the short-term moving averages here, they're starting to stabilize a little bit. And basically what I was watching was this. I said, typically in the stocks, they do a short-term sort of a retest, the double bottom retest. And this is very critical. Look what happened here at 11:39. You can see here that, the market bled down a little bit. And I was getting a little bit nervous, thinking, this is not bouncing immediately. And the bounces so far has been rejected there and rejected there. But the critical thing is that you don't want to see it sort of collapse through the recent low. And this is a beautiful candle here, kind of reversal candle just here at 11:39. And that gave me a bit of confidence to sort of stick with the trade, because once you see that followed by some aggressive sort of green candles, then we also started to see NASDAQ push up. You started to see the SMH, so the semiconductor ETF push up. And of course, then you start to see the moving averages cross over. So you see here that the very shorter term ones start crossing over the longer term ones, and you start to get this nice sort of push upwards. Great. That's been confirmed by NASDAQ. That's being confirmed by the tech stocks, and life is good. Now, of course, what's happening at this point is that my premium, remember, I paid $2, or I received $2, sorry, not $2, 2 points to get into it. And of course, that starts to come down and down. So at this point, it's at 250, so I'm 0.5 point offside. Here, it's at about 250. I'm also about 0.5 point offside. But as soon as we start to get some green candles, we start to get the theta burn. So you start to get the time decay really starts to be very aggressive on this 0 DTE. This is 0 DTE. And you see that once you start getting to 11:30 midday, the theta burn really starts to come in very, very aggressive. And what happens is that the market is not so much pricing, sort of theta or anything like that. It's actually pricing in the probability of achieving the target. Once you get away from the target up here, the delta starts to drop very, very dramatically. So what we start to see here is that by about just after 12 o'clock, sorry, there's a siren outside. After about 12 o'clock here, you can see here that we're starting to get up to a little bit of overhead resistance. You see here that the market is starting to flatten out. You can see here that the MACD starts to flatten out. And then on the stochastics on the RSI, you can see in fact, it starts to be a little bit overbought. So at this point, I looked over and I could see that my premium, for which I had received 2, points had now actually collapsed a lot. It was down at about 20 cents. So I was on side about 80, 85%, which is great. And at that point, now, could I have held it? Absolutely. But I decided to actually exit at this point up here. And why is that? Just because, and we'll again, I did another screenshot at about when I exited, which I can show you guys, which is here. Let's have a look at that. So you can see here, so just notice the difference. Again, the option chain, and you can see that this one was done at 12.22. So now look what's happened here. The delta, the spread of my delta when I entered was about 8 for the whole spread. Now look at the delta now, 1.9, almost zero, completely out of the money. Now, could I have held this and would this have expired naturally? Probably, but I don't like to take risks. It's lunchtime. I want to go and have lunch, close the trade. Now look at this. Remember that I received 2 points and it's now gone down to 20, 0.2. So basically out of a maximum of 2 points, just, you know, the short put spread expiring dead and out of the money, I've taken 1.8 out of 2. That's 90%. That's fine. Now, the point is, you say, well, Angus, why didn't you just let it expire, relax? You're going to out of money. You never know. It's Trump. There could be a tweet, etc., etc., etc. And I don't like stress. So at this point, my personal rule is that if you've had a great trade like this and you've got 90% of the maximum premium, why are you trying to get 1/10 of 1 point as more money when potentially you could actually go and lose, you know, sort of 5 or 6 or 7 or 8 points, or even potentially $750 in the worst case crazy scenario. Not good risk reward. So at this point, I decided to close it. And what I want you guys to notice, apart from the delta here, remember that the starting deltas were for the short put was at about 21 from memory, and that's now gone to a delta of 4. So completely deep out of the money. And then if you look at the long put, which was at about what was it, about 11 or 12, I have to go back and check that. That's now gone down to 2, which gives me the total delta of the spread at 1.9, completely out of the money. It's completely collapsed the premium, and of course I exit there and I take a profit of 1.8 points. Keep in mind a point is $50, so that's 1.8 times $50 on however many contracts you traded. I won't tell you how many contracts I traded, but a few contracts there. So that's the way to do it. Now you say, well, why didn't you hold it and let it bleed out? The problem is that in, you know, the risk reward at the end of these trades, you never know what's going to happen. You need also to manage your sort of mental stress. So the point is that, you know, I exited, as you see here, and for 90% of the maximum possible profit. Now, could I have exited up here and got another, you know, 1/10 of 1 point? Yes. But look what happened. Remember that these guys don't expire until 4 p.m. and I'm recording this at 4:16. So the point is that there's 4 p.m. So the point is that at 3:18, this has gone all the way down there. Now it's still out of the money and it's probably going to expire worthless, but this is just a lot of stress for literally 1/10 of a point. Complete waste of time. If you guys have achieved on a short put, if you're selling credit spreads, if you've achieved within 2 hours, which I did here, I entered at 10:20-ish and exited about 2 hours later at 12:20-ish for about 90% of the maximum profit. Absolutely no sense in risking any kind of late day sell-off or Trump tweet or World War III breaking out. So that's it, guys. That was just, as I say, real life trading today for selling a put spread on the ES futures, which personally I love to sell. I love to trade sort of options on the futures. Hope that was interesting. If you want more of this kind of content, check out The Macro Shop at YouTube, on Twitter, where apart from the morning sort of macro snapshots, Nick also does his technical analyses, and we do all kinds of other stuff over there. Thanks very much. I hope that was useful, and I'll be back with more probably later this week. Thanks very much. Have a great afternoon.